caused the economic crash of 2008. The short version is a crash in the United States housing market. The housing market is ginormous. It's $52 trillion. Total apartment value is about $14 trillion, so we're talking $66 trillion of housing. That is 2.5 times larger than the United States GDP. So when that crashed in America, everything crashed. What made it even worse was that there was trillions of dollars of financial instruments invested in the values and mortgages of these homes. We call these financial instruments derivatives. They are a type of financial contract whose value is dependent on an underlying asset. In this case, it would be homes. In the 1980s, banks decided to make bonds out of mortgages from people who have incredible credit. They were called mortgage-backed security, and they were looked at as something that could not fail. And these bonds are a derivative because they were derived off of the mortgage payments. Eventually, these bonds sold like hotcakes, but there is only a certain number of people with great mortgages that you can make bonds out of. Banking firms started making these bonds out of people's mortgages who had not so great credit. Of course, every president at the time wants home ownership to keep going up under his term. Banks were given the go-ahead to give out home loans as easy as possible. Some of these loans were for 100% or more of the home's value for people with questionable credit. Few people were worried about these subprime mortgages being given out so easy because a lot of them, along with most of the mortgages, were guaranteed by two government mortgage agencies, Fannie Mae and Freddie Mac. At the time, they guaranteed about 50% of all U.S. mortgages. And it wasn't just banks and risky investors that were buying these poor securities. They were mutual funds, corporate assets, and pension funds. And everyone thought that these investments were going to be perfectly safe because they had a form of insurance. The group that supplied this type of insurance was called AIG, American Insurance Group. And the top 3 ratings agencies were in on this too. Moody's, Fitch, Standard & Poor's, they gave them AAA. Eventually, people who were given these very easy loans were not able to pay their mortgages and they had to default. And it wasn't just a few hundred, this was a few million people. Tens of thousands of people began vacating their homes every single month. The inventory for empty houses started to rise, even before the recession happened in 2008. Another word for inventory is supply. So what happens when supply goes up? Prices drop. And in 2006, housing prices began to fall tremendously. Investors were happy because they thought cheaper home prices would mean more people would be there to buy them. But no. The value of trillions of dollars of all these super bonds started to drop. The insurance companies did not have anywhere near enough cash to protect against these crashing bonds. And people found out that their own mom and pop bank on the corner was investing in these assets as well because the regulation that protected us from these types of gambles was removed. Bear Stearns, one of the oldest banks in the country, collapsed because they bought too many of these toxic assets and there wasn't enough insurance to cover them, because Fannie Mae and Freddie Mac couldn't cover a systemic catastrophe. By 2007, a credit crunch was already happening amongst the banks and they weren't lending to each other, but we weren't getting any notifications of this. Then Lehman Brothers, another one of the oldest, most established banks, ended up collapsing and the US Treasury did not have authority to bail them out yet. It was the fall of Lehman Brothers that was the wake-up call for the world economy, and we started to see a huge run on the banks. And the rest, we all know. We faced a near economic collapse. Do I think we're going to see a similar real estate collapse anytime soon? No. The only real estate sector that is suffering right now is commercial real estate, namely the office sector, which is only $2.10 trillion of the real estate market, which in its entirety is about $119.8 trillion, so it's not even 2%. A lot of influencers are trying to convince you of another collapse because they want the views. Today at 8:30 p.m. CST, I will be interviewing Christopher Clark, an economist and an actual professor of economics, to talk about what's actually going on in our economy. I'm the Gio Husar, and I'm going to try to interview as many economists and financial experts as I can. Thanks for watching.